Good morning, everyone. This is Rashmi Shah from Simplicity Investing. I'm doing this webinar from Dallas because I've been stuck here because of COVID-19 situation. And uh, so before I start today's webinar, let me uh, put my disclaimers that this webinar is for investors and our clients from India. And in this webinar, we are not promoting any products or any investments. This is just for general information and education purposes. That what is the outlook uh, for 2021, global outlook for investing, and how do we see what's going the next 12 months, and what is the strategy Simplicity is going to implement. So this is based on that, and yeah. So let me start today. Yeah. Thanks for joining. I appreciate it, your time. And most of you, I know you watch this webinars afterwards when you get time. So, 2020 was the year when the world got jolted by Corona 19, COVID 19 situation, correct? None of us have experienced this in our lifetime. This is happening after 100 years. So this was a unique experience for the world. And this happened in the month of January, February, and March. And now we are in the final phase of COVID-19 situation, where it is very aggressive in at least in America and Europe, and the second, third, or fourth wave, whatever you can call it. And but the world economy is in rebuilding phase now. So after the damage done by COVID, world lockdown in the month of March, April. So that's the situation, correct? That was 2020. Before we start what's going to happen in 2021, let's summarize what happened in 2020, correct? So what happened in 2020? In February, the markets were at 52-week high in India, America, everywhere, correct? They were at 52-week high here on February 14th or 15th. You see this? And this is US, this is India. This is US, this is India, correct? And the stock markets tank straight off the cliff, 35%, straight off the cliff in the span of 30 days, 35 to 50%. So when as the lockdowns were announced in India, America, everywhere, people didn't know. This was the first time they're experiencing the lockdown, and they didn't know. So the markets reacted, and worldwide, a lot of derivative positions were there, and they had to be squared off. So that derivative positions created such a panic, and that's why this kind of a fall happened. As we all know, for every $1 or ₹1 invested in stock market, there is a $9 nine times derivative positions. So every financial institutions had to unwind those derivative positions, and that's why this fall happened. This fall didn't happen because people was those who were holding stocks, they were selling. This fall happened because all long derivative positions were getting squared off, and that's why this fall happened. And it was such a steep fall, and nobody knew where the bottom was. But those who had courage to enter here in the market, when it turned around in the month of after 20th March, the market turned around from their bottom. S&P 500 has gone up 64%. This is 64%. It and Nifty has gone from bottom till here till today. It's 74%. What a run it is, correct? This was minus 40. So this was the run, correct? So it's a fantastic rebound. We saw that. I've never experienced this kind of a rebound in my life. I'm 60 years old, and I've been in stock market in this business right from the age of 17. My entire life. I'm a chartered accountant and a CPA from US, but I have earned and lost more money in stock markets than in my jobs or career or profession anyway. So my entire life is based on stock market and financial markets worldwide, correct? Now, this is a slide I'm reproducing what we, in my first webinar in April 2020, when I said that, the US economy will be the first to rebound, and that's what happened. The US stock market will be the first to bounce, and everything else will follow. And cloud computing and digital economy will, IT cash-rich companies would, and social distancing. So these are the trends will happen, and this is the place where one has to invest. And yes, those sectors give very good return. Those good sectors give very good return. They led the markets, and that happened, correct? The small cap and mid cap, that turnaround happened in last month, but they were the last to turn around, correct? And there's a massive shift happening in asset allocation from real estates to financial assets worldwide. That also the trend. So this we projected in the month of April, and that happened. And this is going to continue to happen, correct? And this for 2021 also this is going to happen, continue. Now the second major event of 2020 was the US elections, and what an election it was, correct? What an election. So without being emotional, most people vote emotionally. I'm not an emotional voter. I'm a very analytical, and so when the objective as a voter is to vote what is best for the country, not what is best for you. But most people don't vote what is best for the country. They vote what is best for them. Oh, I don't want to pay high taxes, so I'll vote for the person who doesn't believe in high taxes. So, so most people vote emotionally. Actually, your job as a voter is to vote what is best for your country. So I've seen this trend in India, in America, everywhere. But what an election it was. This election also, though Joe Biden won by more than 7 million means 70 lakh votes overall, still Donald Trump is contesting, and he believes that there was fraud. There was no fraud. It's one of the most secure and election. US is the most oldest democracy of the world. It's considered to be the temple of democracy, and unfortunately his inability to accept defeat is people are but the system here is very strong, and the system will take care of his emotions, and eventually Joe Biden is going to be the president of US in 2021, in February 2021. But what we also saw, the power of social media, and there are a lot of things to learn from this, that how much false information and propaganda gets spread through social media networks, and people start believing it, correct? People start believing in it. And so if you do some lessons to be learned from 2020 elections on, there's some very interesting behavioral articles. If you do a Google search, very interesting, and it will throw light on how we think and how we behave, correct? It was a very trend-setting in election, and it will have a global impact, correct? So the impact, so there is a change of administration, and you will see a major change. Joe Biden is a more policy driven, Donald Trump is more personality driven. So the way they both govern is very different, correct? Very different. So you will see a major changes in the way the US policy and the US economic policy and domestic policy, international policy will shape up in next year, and it's going to be a very interesting time. So we'll see that happening next year. So that will also have impact on the financial and stock markets. But the impact of this is much less than other things, which I'll talk later part of this presentation, correct? Now, coming back to what do we see happening in 2021? So as of today, what we know, there are many things what we know, and many things what we don't know. So if I was doing this webinar last year in December 19, I wouldn't have predicted that COVID-19 is going to happen and there's going to be a lockdown. So that is what the unknown factors, but there were many known factors, correct? So what is the known factors we know today? That COVID vaccine will be out. Now what they are saying is the COVID vaccine is already out, and the US government is planning to give the vaccine to every citizen, offering to them by July. The vaccine will be available to anyone in America and Europe. Now, US, today I read in the news that US government is also planning to propose a legislation in the Congress where anyone who takes vaccine will be paid $1,500 as a stimulus. So that will be incentive for people to take vaccine, and they'll get a check of $1,500. So everyone, because they want, because many people think, oh, I don't believe in this vaccine and all that kind of stuff. So to discourage that, they are offering this kind of stuff. So it's going to be interesting. Now, in developed economies, everyone will get vaccine. In developing economies like India and Southeast Asia, other countries, it's not possible to give vaccine to every person because the population is huge. So government of India has already announced that they won't vaccinate everyone, but if the moment 50% of population is vaccinated, there'll be herd immunity, and that's how the virus will come under control. So every country is following a different approach. Then in 2021, there is no major national elections, correct? But there is going to be geopolitical turmoil. China fears Joe Biden more than Trump because Trump is a negotiator. You can deal with a negotiator and a deal maker. You can't, it's very difficult to deal with a policy maker. So Joe Biden works on a policy and he doesn't do deals. So China is more fearful of Joe Biden than Trump. And many people in India think that Trump was very good for India because of he attacked very negative against China. But that's not true. You will see Joe Biden is more against China than Donald Trump, and it's more difficult for China to deal with Joe Biden than difficult with Trump. So you'll see all those geopolitical turmoil and many things. Then there's excess liquidity that will lead to inflation. Okay, so what has happened because of COVID-19, about 15 to 18 trillion dollars have been pumped worldwide. Cash. Now, COVID situation, and what has happened is because of that liquid cash floating around everywhere, and people not able to travel, so a lot of the savings rate across the globe has gone up. Okay, so the bottom 20% of population in India or America, they have suffered because of poverty and they didn't have savings. But the rest of the population, 60 to 70% of the population in India and America, their savings rate has gone up because they were staying at home, they could not travel, so all the discretionary expenses were not there. So a lot of cash has been sitting in. So they say in America today, almost $5 trillion of cash is in money market account. That much cash is lying everywhere. And this excess liquidity, as the economy starts opening up, people will go, pent-up demand will come and people will go for shopping, and there will be shortage of goods. I already see that in America today. I just ordered a refrigerator for my home this week, and the waiting list is 45 days. They are not in stock, what I wanted. So even new cars are not easily available. Discounts have gone. I've never seen on online shopping, they're saying the website is very busy, you're in a line and your number is 650. I had never seen that. I saw that last week. This is going to lead to inflation in second half. So interest rates have bottomed out. So this is a very major development. I'll tell you what this implies in the later part of the presentation. Global supply chains are going to see major changes. Every country wants to be more independent and they don't want to be dependent on China. So you're going to see every big company will try to source products from different countries. So India is going to benefit there. As I said, interest rates have bottomed out. Real estate, commodities, stock markets are all in a new bull market. So even real estate market in India bottomed out in the month of April, May, and now it's in a new bull market which will last for a number of years. Same cases in America. In America, the real estate is very hot just now. So if, like where I live in Dallas, if I put my house for sale, it'll get sold in 2-3 days. There are hardly any houses for sale. And if you want to buy a new home in America today, the waiting list is almost 18 months to 2 years because labor is not available for construction, and there is a shortage of material, lumber, and everywhere. So the real estate is in boom. Global supply chains and massive pent-up demand, correct? People, as the COVID situation eases in America, people are going to go more shopping than what they have been doing. The pent-up demand is, the malls, everything is going to get flooded after June, July. That's what they're predicting here. And 2020 year like one is going to be again full of surprises. In spite of knowing all this, you will see many new surprises happening. So how you deal with that? How do you deal with that? And that I'm going to talk at the later part of the presentation. Now, coming back to as I said, in COVID-19 situation, by July 2021, everyone is expected to get vaccine in America, and they say by September, October, there won't be a single COVID case in the US. That's what the projections they're making, and that's why the market is bullish about it. In India, it will take much more longer. Coronavirus will get completely under control in 2022, a later part of that, but in America, Europe, it will be in 2021. That's what the reports here are saying. That's not my view. It's what the specialists are talking about in America and Europe, correct? That's what the market is expecting that. Now, as I said, 200 years of interest rates have bottomed out. You see, this is a chart for 200 years of interest rates. In 1981, interest rate was 16%. So in 1981, I've seen that in 1981, fixed deposit rate was 18%. I have seen my clients having fixed deposits of 18-19%, bank fixed deposit. Can you imagine a bank fixed deposit giving you 18-19%? I've seen a dollar deposits I've seen 14, 15, 16% interest rates. I've seen mortgages having 21% interest rates on loan. So that was the peak in 1981. From there, the interest rate started dropping, and it has practically gone to the lowest in the last 200 years. So from 1980 to 2020, 40 years, there was a massive boom in the debt market. So the debt market, so as interest rates fall, bond prices go up, so you get capital appreciation. So there's a massive, now interest rates can't go below this, and they're expected to take a U-turn. So today they are saying is the debt market is more risky than the stock market, because as interest rates, when they turn around, the bond prices are going to fall. And 60% of financial assets worldwide are parked in bond market. Only 40% financial assets are in stock market. So bond market is much bigger than the stock market. So they're expecting next 1 or 2 years, bond market is going to be very volatile and very risky. So then the stock market. So this is one of the things which you need to watch. Don't go for long-term bonds or long-term debt funds. If you're parking your money in debt funds, park it for short-term. Don't go for just because you're getting 0.5% or 1% return yield more. Don't risk your principal. That's what we advise all our clients, and that's we need to watch. But bank fixed deposit rates are not expected to go up, but they're not expected to go down also, at least for next 1 year, and that is the trend we are seeing. Now, the other thing, so the stock market turnaround. This interest rate is the number one catalyst for the influences on the stock market. So that we are going to see. The other trend which we are seeing in 2020 is individuals and families have become rich across the globe. Families have become rich. but the government has become poor. So if you take India or America, everyone's wealth has gone up because of the stock market rally in the real estate market. But the governments have gone broke because they printed more money and distributed. So that's the situation, correct? So individuals are rich, but the country has become poor. And this is not only in India, it's across the globe. America, you name the country, every country's balance sheet has become bad. So that is the other thing we have to watch. So how they can repair the balance sheet? The balance sheet can be repaired only by increasing taxes or increasing the revenue for the government. So you will see even tax rates have bottomed out across the globe. Across the globe, tax rates have bottomed out. Income tax rate or GST rates are not going to go lower. They are going to go higher only. Not in 2021, but 2022 23, because the governments will have to increase their revenue. So that is the other trend we are seeing. So this is the macro trend which we are watching, and this has a lot of implications on the portfolios, how we invest and all that. So that we as a organization, I watch and I direct the clients my portfolio accordingly or restructure that, correct? So this is another thing we have to watch out for. Now, this is a slide which I'm showing you how the world is changing, correct? How so let me give an example. 1980, the top 5 companies. Okay, I'm giving more examples here of US than India, but why I'm doing that? Because the US market is a 40% of the world stock market. India is only 3%. So the Indian stock market gets influenced by the US stock market. So every investor in India needs to understand how US market functions and how it influences their wealth in India. So the same, whatever happens in America, it's going to happen in India. The same trend. So in 1980, the top 5 companies by market cap were IBM, AT&T, Exxon, Standard Oil, and so of all these 5, none of them today are there. Today, then in 1990, IBM was there, ExxonMobil, GE, Philip Morris. This is a tobacco company, and Royal Dutch Petrol. So you see mostly oil companies, and there is only one computer hardware. IBM was that time computer hardware, not a computer software company. GE is the industrial, correct? Then in 2000, GE became number 1, again oil, then pharma, Pfizer, Citigroup Bank, and Cisco. Again, Cisco is also a hardware company, correct? Not a software company. Then in 2010, again oil, Apple and Microsoft came first time in the top 5. Then Berkshire, this is Warren Buffett's company, and GE, correct? So there were only 2 software and technology companies, and the 3, one was industrial, one was insurance and general, and this is oil. Now, but in 2020, you see everything is software. Apple, Microsoft, Amazon. So you see how the sectors are changing. Now, so the most important thing in your investments, if you have to understand the sectors, not the companies. So as you all know, those who know Simplicity and those who know me, we are specialists in theme-based investing, sectors investing. We do not invest in generic funds like large cap, mid cap, small cap. We don't do that because there is a very high risk that in stock picking you will make mistakes. Even the fund managers make mistakes because they go by theory, correct? Theory actually doesn't work. The sectors, most important is to be in the right sector. So if you're in the right sector, the worst stock in the right sector will give you better return than the best stock in the wrong sector. So the sectoral selection is very important, and that's where Simplicity is focusing. And so in 2030, which sector I predict, correct? I predict artificial intelligence, AI. The top 5 companies will be mostly from artificial intelligence and technology at a different level, correct? 5G technologies and all those kind of things will be there in 2030. You will see, you won't see oil companies coming back. You won't see old economy stocks coming back. So I give people examples, dhotis in 1950, I was born in 1960, 70s, and when I was growing as a kid, I used to see many people wearing dhoti. But now, how many people wear dhotis today? Correct? So the trend has changed. Dhoti is never going to come back. Correct? Same thing. What was popular 50 years back or 30 years back, it's never going to come back. The world has changed, and because of climate change, oil companies are never going to come back. See, tobacco companies, they were very popular in 1990s, correct? Today, nobody is investing in tobacco. It's considered sin companies, correct? I have never invested in my life in a liquor stock, gambling stocks, tobacco stocks. So I invest in companies which create happiness, not create vices, correct? I never invest. Those are very profitable businesses, but I don't invest. So that kind of trend is going to be there. The same trend is, so you will see more. So sector selection is very important. 2030, correct? Then now, if you take the top 5 companies, if US, they contribute 23% of market cap of America. This is the highest in the history of US, correct? Now, same cases happened in India. The top 5 companies contribute more than 35% of the market cap of India, and that's why many of the large generic funds underperformed and give poor returns, because the fund managers mostly went for searching for new and small cap and mid cap, and they never perform. Now, that's why we don't invest in those kind of things. We invest in thematic funds, correct, where this kind of capturing happens. Now, I'll give you another example. In India, the definition of large cap, small cap, and mid cap is based on SEBI, but that definitions foreign financial institutions don't follow. The definition of a large cap is a company which has market cap of more than $200 billion. Is called a mega cap. 50 billion to 200 billion market cap is called a large cap. 20 to 50 billion is called as mid cap. You know how many companies in India are mega cap? 0. There's not a single company which has a market cap of about $200 billion. There are only 3 large cap companies which has a market cap as per the definition of the US, which is more than 50 billion. That is Reliance, HDFC Bank, and TCS. These are only 3 companies which has more than $50 billion market cap. So every FFI or mutual fund which comes to India for investing, they have to have the stocks. 60% in your portfolio has to be large cap. So every big fund has to have 60% of those stocks. And you know how many mid cap stocks are there as per the definition of America? In India, there are only 18 mid cap stocks which have market cap between 20 billion and 50 billion. So they have to invest in those 18, and the rest are small cap. The small cap allocation is less than 10% in anyone's global portfolios. So you have to, as an investor, 70 to 80% of your portfolio in India has to be between those 18 companies. There's 21 companies, correct? 18 mid cap and 3 large cap. But how many investors have that kind of allocation? Very few. So you have to understand the global picture. So that's why I say we first at Simplicity, we look at the global picture and then design the local portfolios for the client. And that's the reason we did very well last year. Now, as I said, rising government debt. See, this India is not in a picture here, but India is still a very small country in the world. So I'll give you an example why. Let's imagine a person who earns a salary of 2 crores and a person who earns a salary of 5 lakhs. Who will be able to get a bigger housing loan? A person who is able to earning a salary of 2 crores. So a person who earns a salary of 2 crores will have a large debt, more debts than a person who's having a salary of 5 lakhs, because he'll have eligibility criteria and loan criteria. Nobody will give him more than 25 lakhs loan. A person who's earning 5 lakhs, correct? Your debt can't be more than 5 years of your gross income. But a person who earns 2 crores can raise a money of 8 to 9 crores to buy a property. So same way, the US has the largest income in the GDP in the world. So that debt is the largest. Japan. So you see the the size of the economy wise, the debt's also larger. So you have to understand in that context, correct? Many people say, oh, US is bankrupt because they have borrowed too much now. Because US is a very rich country, the income is very high, they are able to raise more money. And that's why the dollar is considered to be the safest currency in the world. You have to look at it from a different perspective, correct? You have to understand differently. Yeah, so this is rising government debt. Now, this is the information I'm sharing as a background, because this is all implications of what's going to happen in 2021, correct? Now, coming back to bankruptcies and foreclosures, because of the money they pumped when lockdowns happened in month of March and April, many people thought there will be a lot of bankruptcies in US. But the US government printed so much money and gave so much stimulus, the bankruptcies are at all-time low. The bankruptcies are at all-time low. So this data is from 2003 to 2020, correct? So you see the bankruptcies, the maximum bankruptcies happened between 2006 and 2010, when Lehman crisis happened. Now, as the economy starts reopening, you may see a spike in a little bit of bankruptcy, but it will never be that this close, this way. Now, so this is a very interesting perspective. Many of us were thinking that there are many people went bankrupt because of COVID now. Expenses also came down, correct? Everyone is staying at home. Yeah, so a lot of the COVID thing also had some positive fallouts on the personal finances of people, and this has happened. And the other thing, there is a debate everywhere going, whether growth stocks or value stocks, correct? So here I'm sharing what is a growth stock. Growth stock is a stock which is disrupting everything and growing at a very fast pace and changing the shape of the economy. What is a value stock? Value stock is a stock where it's an established, mature company, and it's not changing, but it has a very good balance sheet. It has a very good balance sheet. So all oil companies in the world, or you take even PSUs in India, have a good balance sheet. But they are not disruptors. They're not changing anything. And so they didn't do very well in the stock market. Now, so there is a debate going on, correct? So if you see 2010 to 2020, this is large cap and growth. If this gave the benchmark return, the small cap value and value gave the minus 126. They underperformed by 126% to the large cap growth. So you see this underperformance. So this period, correct? Let me go back to that slide. Now, but between 2001 to 2010, it was reverse, correct? The value stocks outperform the growth stocks. So this is a 10-year cycle, this is happening. So what is going to happen for the next 10 years? We are going to get mix of both. We are going to get a mix of both. The reason I'm saying we are going to get mix of both, when growth perform, when there is a major disruption in the market. Now, these technology companies are, the disruption is going to continue as 5G, artificial intelligence, and all that kind of stuff happens. So I'll give you an example. I'll give you a real life example. When I was a kid in 1970s, people used to say he's a bathroom singer. So people used to sing in the bathroom, correct? In 1980s, people used to read newspapers in the bathroom. 80s. In 1990s, people used to listen to music in the bathroom using a Walkman. In the year 2000, what people used to do? People used to listen music on iPod in the bathroom, or play video games in the bathroom, correct? In 2010, what people were doing? People started using the mobile phones and chatting from the bathroom. And in 2020, what people are doing in the bathroom? They can shop, they do the online banking transactions, they even Zoom meetings they attend from bathroom, correct? So you see the progress the bathroom has made. Okay, don't get offended by example, but this is real, correct? So if you see in America, the new homes, the bathrooms are they invest the best, and they are very sophisticated bathrooms, because they know most of the things happen from the bathroom. And so you see the progress the science has made on the bathroom, the technology, correct? So the disruption technology today, the technology has become so powerful that you can work from anywhere, you can do anything, you can shop, correct? Today people are shopping. This year online shopping has gone by 80% in America. They are saying the paper currency is going to vanish in few years, everything is going to be digital. Everything is going to. I have not used a single paper currency. I've been in US since February. I have never opened my wallet. I don't have carry more than $10, and what $10 were there in my wallet in February, they are still there. Nobody uses paper currency here. Everything is digital. So technology, so when this kind of disruption happens, value stocks don't perform, it's the growth stocks perform, and the growth stocks are going to continue. So in your portfolio, so the portfolios we design, we have normally 60 to 70% growth stocks, 30% value stocks. This is the ratio we maintain. Yeah. So this is a very important thing to understand, and this trend is going to continue for next 10 years. Now in next 10 years, what do I see, correct? What sectors I see? So blockchain technology, genomic sequencing, robotics, energy storage. Tesla is the classic example, so which has given how many percent, correct? Elon Musk net wealth has increased by $100 billion in just last 1 year. It has never happened in the history of the world. Even Bill Gates never became so rich so fast, or even Steve Jobs, Warren Buffett. No one has become. Because Elon Musk net wealth has increased by $100 billion because Tesla is a energy storage, battery operated car, artificial intelligence, fintech revolution. So these are the sectors where 60 to 70% of your investments should be there, and these are the sectors which we are going to grow. So this is the way when we design the portfolios, and we don't pick up stocks. Stock picking is going to be very risky. It's going to the easiest and safest way to play the market is buy a sector and buy the entire bunch of stocks. It's very difficult to make a choice whether Infosys will outperform or TCS will outperform. Instead of that, why don't I buy the entire IT sector and invest it, correct? Then doesn't matter whether Infosys, TCS, Wipro, or they all move in one direction, correct? And so that's how you can create maximum wealth. Stock picking is going to underperform over a longer period of time. Buying the entire sector is going to give you better returns. So that I have learned in my 40 years of experience. So this momentum is going to get more and more. Now, let me give you another example. So this blockchain technology, genomic sequencing. So this kind of stocks are not available in India today, but they are available in US. So every person needs to have exposure, no matter what. At least 15 to 20% of your net wealth has to be in the US stocks. And the second most innovative economy in the world today is Japan. Japan is very good in innovation and technology. In fact, in many aspects, the Japanese companies are way ahead of in technology than US also. So they are the three most innovative economies in the world today are US, China, and Japan. Now China has a structural problem, trust problem. So let's say we avoid that for the time being, but everyone should have exposure to Japan and US, because this sector's best companies are in this country, like Sony, Nvidia, correct? So all those companies are either for Japanese or for US companies, and so that portfolio you should be there. So in 2021, this sector will give a better return than anyone else. I already see that. Now the other thing, people say, oh, the markets have gone up, should I get in and get out? So let me share the data, the bull and bear market cycles for last 35 years. So this data is for the Indian stock market. Whenever markets change by more than 20% from 52-week high or low, the cycle changes. Correct? So if markets fall more than 20% from the 52-week high, a bear market starts, and from the bottom markets go up by 20%, a bull market starts, correct? So that's the cutoff thing to. So I started this exercise from 1985. So the bear market starts in 1986. It gave minus 25% return. It lasted for 16 months. But then the bull market after that was for 48 months. See, 3 times, and it gave 276% return. Then again the bear market came. This is Harshad Mehta time. After this is Harshad Mehta time, the bull market was there. After Harshad Mehta, this bear market came after he was raided, correct, in 1992. I'm sure you're all watching that 1992 scam movie, that TV show, correct? 13, this thing. It lasted for 13 months. It gave minus 61%. Then again a bull market started. It gave 83%. So the bull market always gives higher this thing. Then a bear market started for 17 months, minus 42. Then 18 months, 45. So the cycle keeps on going. Now if you see from 2000, in the year 2000, when the technology Ketan Parekh, correct? This is Ketan Parekh where bear market started. It lasted for 18 months, but the next bull market was for 78 months, and it gave 215% return. Then again the bear market started in because of this crisis in US. Then in 14 months you got minus 73, but the bull market came and it recovered and gave 91% return. So current, this is 2010, again for 12 months, 26 minus 26, 96, correct? Now the current bull market, the bear market, last bear market was only for 3 months. The shortest bear market we had from December to March, and it gave minus 30% return in that phase period. But the bull market, which started in March, so far has given us positive 43% return. So this data is as of last week. Last week's returns have not been updated here, but so this is a law. Always you notice the bull market is for much more longer duration than the bear market. So this bull market may last 12 to 18 or 24 months, correct? It has much more legroom to go. Now many investors in India and first-time investors in America, those who don't have experience, they think we should get in and get out of the market. So it's not okay. My advice is it's not a good thing to do. Why? I'll tell you. I'll give you a very simple example. They say the stock markets are like a roller coaster ride. Yes, I agree. Stock markets are like a roller coaster ride. So the markets go up and like this. This is a roller coaster, correct? Now, let's say you go for a roller coaster ride. In any theme park, like you went to Disney World and you sat in a roller coaster ride, correct? So when you sit in a roller coaster ride, when your ride goes up, that's a bull market, and you get scared and you say, let me jump out of it. You jump out of it, what will happen? You'll get injured, correct? The safest way to finish that ride is let the whole ride go through. How many people die in that ride if they sit through the whole ride? 1 in million, correct? 1 in million. So if you go through the entire economic cycle, your chances of making losses are 0. But if you try to get in and out of the cycle, the chances of you getting hurt and losing money is more than 80-90%. It's simple common sense, but people have wrong notions. They think they are smarter than the market. Please don't do that. Please don't do that. And this is the most childish behavior we see in most of our clients. So this is the biggest concern I have people. More money people have lost more money this year in the bull market by exiting the market. And trying to time, no, I'll wait for market to correct. No, I'll wait for the market. No, when the roller coaster ride starts, get in and enjoy the ride. Enjoy the ride, correct? Don't try to time the jump in don't think smarter that you are smarter than the stock market. Stock market or global markets are like an ocean. I have made a lot of mistakes in my life and I have learned through that. I have made money also. But if I look at all my mistakes in my life, so it was childish behavior. I tried to time the market. I have learned a hard way. I'll give you classic mistakes which I have made. I had 60,000 HDFC Bank shares purchased at 25. And if I had never sold them, imagine how rich I would have been, correct? But I tried to, and the last, all those shares I sold, 600 which I were left in 2006 at 6,000. But if I had never sold them, I don't have to do any investments in my life again. I had 1 lakh shares of Reliance purchased at 98 in 1999. 1 lakh shares. After that, Reliance has given 1-to-1 bonus at least 4 times, and today it's 2,000. Imagine how rich I would have been. I sold that 1 lakh shares which I bought at 98 at 107 or 8. I was so happy I got 10% return in a span of and I had taken delivery, correct? So all those are, I consider myself a stupid, childish behavior, getting in and getting out of the market. I have learned all these lessons of this very hard way in my life. Trying to time the market is a very expensive education. It's more expensive than Harvard college degree. I'll tell you, I guarantee you that. So don't do that. Don't try to learn a hard way. Go through the light. Now, how the asset class have moved over the years. I'll give you another example. So this is the data for 1990 till 2000, correct? So which are the five asset classes I've taken here? Indian equity, debt market, cash, cash means bank fixed deposit, gold, and US equity. So in 1990, Indian equity gave the highest return, 34, debt gave 9%, bank deposit gave 9%, cash gave, debt market, debt funds, cash, bank deposit gave you 8, gold gave you 2.3. So every year you see that cycle. Now this chart is very interesting chart. It will product for 220. I have done only for first 6 months this data. Now if you see in 2002, gold gave the highest return. I'll just mark gold gave you highest return. In 2008, gold gave the highest return. In 2010, gold gave highest return. 2011, gold. Now let's watch what happened to Indian stock market when gold gave the highest return. Indian gave 9.8. Here India was at the bottom, 57 minus 57. Here again India gave only 14% return. In 2011 again India was at the bottom. Okay, so now gold has given here, correct? Now see what happened to the year following year. Every time gold gave the highest return. Following year, India was the best performing market, 98% return. Gold, best performing market, 88% return. When this 2 years gold gave, best performing market, India was there. So in 2020, gold was, as of June, now this chart I have to complete after the month end, December, what happens. But gold was, so I anticipate again, Indian stock markets to be the best performing market among these 5 categories. As of today, among the emerging markets, we call it, correct? India is an emerging market. This year, the best emerging market has been Russia. Second best has been Brazil. The third best has been China. India is number 4 in the world today. Among the emerging market to give the best performance, and they have beaten this is the best, so the fourth, and still Indian markets have not outperformed the US market, but next year they expect these 4 markets to outperform the US stock markets. So that is the prediction. Now this is a high level data, correct? So now there is another interesting chart. If I tabulate this chart and look at from a very different angle, correct? Very different angle. How many times India, out of the 30 years, how many times India was the best performing and it was the worst performing? Correct? Here it's worst performing, correct? The worst performing asset class, correct? So let's tabulate that data. So gold was best performing for 5 times in 30 years and worst performing 8 times. So net positive years is only 3. The highest return gold gave in a year was 31%. The worst return it gave was minus 20. 30 years CAGR for gold was 11%. Correct? US equity, the best performing was 6, worst performing 3, net positive was 3. Highest US equity was 80% return. The worst was minus 24. So this is the range, minus 24 to plus 80. CAGR is 15%, very good return in dollar terms. Indian equity, 15 times best performing market out of last 30 years. Worst performing also, highest 9 times, but net positive 6 times. Highest was 98, worst performing was 57. So Indian markets, as you see, are more volatile than gold, more US, but the CAGR is 19%. So this roller coaster is much more bigger roller coaster than the US or gold, correct? The debt is only 4 times equal, net 0, 13, and you see the range, and this is a bank FD, correct? Bank FD, you see this, but bank FD was the worst performing 6 times, best performing 0 times, net positive is -6, highest return was 12%, and the worst was 5%, which is I think this year, and 30-year CAGR is 7% bank FD. So now what I'm saying here is, if you go through a long-term period, 19% CAGR is a very good return, or 15% is a very good return. So you need to invest in a cycle. So you need to invest. So I also have experience. I'm in this business for last 30 years. I've been counseling my clients for last 30 years in India, America, everywhere. So if I look at all my clients' data, how the clients did, correct? So what I've seen is clients who have gone through more than 2 or 3 cycles, economic cycles, they have done exceedingly well. Clients who try to hop in and hop out of the market, they have done the worst. So in the first cycle, so you need to go through a complete cycle. So when you try to hop in and hop out, I'll give you another way of example, that you decide to take a vacation, and from Bombay you decide to go to Delhi. So the train comes to Ahmedabad, then it says, no, I don't want to go to Delhi, I want to go to Calcutta. You decide to go to Calcutta. Then you sit in the Calcutta train, you get down in Ahmedabad and sit from Ahmedabad to Calcutta. Halfway you go, no, I don't want to go to Calcutta, I want to go to Bangalore. Then again you change your train. So if you do that, you can never enjoy the vacation and you are messed up, correct? Same thing in investing. If you try to do that, change your destination every 6 months or 1 year and try to time it, you will be the loser. And you don't want to be a loser. Donald Trump always makes fun of losers, correct? So you don't want to be losers, correct? You want to be a winner. So winner means you stay the course, have a conviction, the world is always going to progress. As I said, see, bathroom in 1970, we used to sing songs. In bathroom in 2020, you can shop and do everything, correct? So the world has progressed. Same way, the world is going to be progressive. My grandfather used to say, Rashmi, you're going to see better world than I saw. Which is true. My kids are going to see a more modern world than I see, correct, in my lifetime. So the world is going to progress because of science and humans' ingenuity. So stay invested. Don't try to time the market. That's the message I'm trying to give. Now, but the biggest risk in 2021 is not the market, is your thinking, how you think. So this, when markets start coming down, you are in the denial mode, then you get angry, then you get depressed, and then you try to get out of the market. Then again, recovery force, and then acceptance, correct? This is the cycle we go through. This is the cycle we go through it. We need to control this behavior. We don't. Now I'll give you a different perspective of the market. S&P 500, correct? If I see S&P 500 index, correct, rolling return. So in 1 year, if you invest only for 1 year, highest return S&P 500 in 1 year has given 60%. The worst it has given 40%. But if you stay invested for 3 years, the highest return you have got 25%. The worst you have got is minus 10 or 12%. If you stay invested for 5 years, you have got a 23-24% return. The worst is you have given 5%, minus 5. You stay invested for 10 years, you have got 18-19% return, and you have got minus 2. But if you stay invested for 15 years, nobody has got negative returns. No one has got negative returns. And you have got 19% CAGR. Very good. 20 years. So this is the lessons you have to learn. You want to be this investor. You don't want to be this investor. Don't think short term. No matter what your age group is, everyone needs to focus on this and not on this, correct? That's very important. I think I'm coming to the last 2 slides of my presentation. So in 2021, the biggest risk is your behavior, how you're going to, so where we are going to focus. But a lot of bad news is going to come. Government's balance sheets become bad. There will be political turmoils. There won't be elections. There will be more tariff war, technology wars, and gap between rich and poor widens. So these are the risks. But this risk is nothing compared to the way you think. So if you control your behavior, you can manage all this risk, not a big deal. Yeah, and investment only perform well if they are in given time to grow. So this is my last slide. I'm going to give you a classic example of the pharma fund. So we have been investing in pharma fund for all our clients in 2014. Now, why we chose the pharma fund in 2014 for all our clients? We said India's population of people above the age of 55 or 60 is going to grow by 600% in next 10 to 15 years, 10 years, correct? So, diabetics, ophthalmology, radiology, all those sectors we are going to do very well. So we said, let's invest in pharma fund for all our clients. And we have been doing investing since 2014 for everyone. But the pharma fund has given in those who stayed invested from 2014 till today, they make a phenomenal return, but they had to go through a pain. I just give an example. Last 1 year, the pharma fund has given 60% return. But if I take last 5 years, these are absolute returns. If you take last 5 years, it has given 66%. What it means is the prior 4 years, it gave only 6% return, and in last 1 year, it gave 60% return. Now, as an investor, if for the first 4 years you got only 6% return in pharma fund, and you said no, I want to exit because it's not performing. See, these are those 4 years. It was not performing, very narrow band, and you exited. What happens? You miss this phenomenal run. Now, if you have got 66% return over a 5 year period, that means you have gotten 13% CAGR, which is not a. It's double the bank deposit rate, correct? Double the bank deposit rate. So it has performed, it's done. So you need to stay invested in the sectors where you have conviction. Now, this is what we do, and this is the way you have to play 2021. I'm expecting 2021 to be at least extremely bullish for next 6 months, because there is such a massive pent up demand, and all inventories got exhausted because 3 months of lockdown. Those inventories go. So there is, every manufacturing company is working at 100% capacity in at least in the US, and everywhere the capacity utilization is going to go up. There is a shortage of labor, there is shortage of material, and that's why commodity prices are going up. So you need to see that, correct? So I'm extremely bullish for the next year. Now, now I'll take your questions. I appreciate for your patience. I went beyond my time. Okay. Yeah. So for one of the questions is which are the AI companies in India? Okay, now we don't have pure AI companies in India, but the companies which are using AI very well is Asian Paints, which they are using AI very well, correct? We don't have pure artificial intelligence companies in India like we have in America. In America, you have recently the company came with Panther, correct? They are specialists in that. Stock has gone up almost 200% in last 1 month. So those kind of companies are coming in US. In India, those companies are not there. India is still 10 years lagging behind. We don't. Now there are good companies which are using them now. AI. So Asian Paint is one of the examples, Hindustan Lever, and they all will be there. But they are the users, but they are not the pure this. Yeah. Then the next question, and many of the tech companies in US are B2C, which brings them higher revenues. Indian industry is more service oriented. What factors restrict Indian companies? Is the mindset, correct? So what factors restrict the Indian IT companies to be B2C? Okay, to become B2C, business to consumer directly, correct? Yeah. Indians are basically there are two. One is group is businesses traders, and one is the manufacturers. So the mindset in India is very different. That innovation, the young generation has just started in Bangalore and Pune, the startups, but they have not reached the scale, and the environment is not there like what is in Silicon Valley. In this, correct? And that kind of stuff has not happened. Indians are more cautious, very cautious. First they want to play safe. Now when you do this kind of uh, startups, you don't have to be cautious, you have to be a risk takers, and that risk taking attitude is not there still in the entrepreneurs in India. Yeah. Mm. So next question I've got is, so Indian technology funds mostly invest into Infi TCS. Globally, we see growing IT companies are Facebook, Google, or other AI companies. Yes, but you need to invest in both. The Indian companies are service companies. They also perform very well. TCS, Infosys, and all those stocks have given 60% return in this year, which is a very good return. Very good return. They will continue to grow next year also. Yes, and we may see certain new IT companies coming in India, but you need to invest in those IT companies are much better than manufacturing companies. So IT sector is going to see information technology change India. If you see last 20 years, they change India. In next 20 years, information technology is also going to change India. So we need to be in that sector. You need to have 10-15% allocation in that, and the companies like Google, Apple, they are in US. They are global scale, correct? So you need to have allocation to that too, correct? So both are different. You need to have allocation in both this. So is it worth to invest in IT funds? Yes, it's worth. It's essential that you need to invest in those kind of companies. Yeah. Yeah. Any more questions? I think that's all. I Yeah, I'll stop here, and if I have not answered any questions, I'll take one to one with the investors. Feel free to. Okay, I have one more question. Uh, how is Tata Motors in electric auto industry? Okay, Tata Motors is playing a catch up, and the valuation is very attractive. So Tata Motors is expected to do very well from the current level. But if you want to play the electric sectors and the software in automobile, a car is going to be the biggest computer for next 20 years. They say car is no longer going to be driven by an engine, is going to be driven by computers, correct? It's going to be a big computers. So then Tata Elxsi is a better stock than Tata Motors. But and I have noticed Tata Elxsi doubles every 3 years. That's a good stock. But you need to both are different, correct? So both are different. What could be the worst case effect of China? Very interesting. No, I anticipate China to do very well. Mm, in fact, I'm exploring a fund where I want to give exposure to invest all my clients in a China fund. We are vetting that fund. We have not yet started that. China has become very strong on technology, and it's going to give a tough fight to US. It's going to give a very tough fight to US. And so they say, like, in 1990s, the last century, they are saying there is a European economy and the American economy, the two big competitors in the world economy. Now they say the two big competitors in the world economy in technology or in anything is going to be US and China. So they are two big different things. So China, in the short run, China is going to be a very positive catalyst to the world economy. Politically, how this plays out, it's going to be very interesting to see. The next question is, do you think Indian market will grow at a faster rate to China? If yes, which sector? I won't say that Indian economy is going to grow faster than China. I'll tell you why. They're two different economies. China is already 10% of world's GDP. India is only 3% of world's GDP. So even if India grows, let's say, at 10%, of 3%, so it's 0.30, and China grows only by 5%. uh, Still is going to be half of 10%, is half a percent. So the absolute wise, China economy is going to grow much larger amount of GDP than India. So I won't compare the two. India has missed the bus um in 1970s to 80s. We were more socialist, correct? We didn't open our economy. We were the last to open our economy. China opened the economy in 1970s, and we opened in 1990s, and still we have still not fully opened up. So India is a very different economy, but there are certain sectors. So other thing I need to we do every person who lives in the country where he's living need to invest 60% in that country and 40% outside that country. So when I get clients, means a US person talks to me, I said 60 to 70% of your wealth should be always in America because you're going to live in America. If you are an Indian, you're going to live in India, you are 60% should be in India, 70%, and the rest should be outside. The return should not be the criteria. So you need to work that. The sectors which are going to grow in India is again, that's how simplicity works, correct? The sectors which are going to grow is again pharma, information technology, banking, and consumers. And those are the sectors which are going to grow. Now, in the short term, commodity companies are going to do well in the short run, correct? Because the commodity cycles have bottomed out. But I wouldn't invest in commodity stocks for next 5 or 10, 15 years. I would invest in those other sectors. Yeah. Mm-hmm. Yeah. Now, uh, the worst, if China is going to be, we need to watch. We need to, so every investor need to understand what's happening in America, what's happening in China, and what's happening in India. So these are the three. So that's our job. We do that. We track all that, and I'll keep you updated in my webinars. After every 2 or 3 weeks, I do these webinars once in 2 or 3 weeks, correct? So my next webinar will be now in Jan. First week I'll do that after the year end closes, and I wish everyone happy year end and happy new year for 2021. We'll wind up, correct? Thank you for your time, and I appreciate it. Thank you. Bye bye.